VIP John AG here. Paper silver closed at $32.47 yesterday. The analysts on CNBC are telling you fair value sits around $88 based on historical gold-silver ratios. But here's what nobody in mainstream media will admit. Try buying physical silver right now. Seriously, try it. American Silver Eagles are sold out at the U.S. Mint. Dealers across North America are quoting 4 to 6 week delivery times. And premiums over spot have exploded past 25% on some products. We have a paper price telling you one story and a physical market screaming something completely different. The disconnect has never been this extreme in my 15 years of tracking these markets, and I'm about to show you exactly why this divergence is the single most important signal you need to understand right now. Let me break down exactly what's happening with verified numbers, because this situation demands precision. As of this recording, COMEX silver is trading at $32.47 per ounce. Gold is sitting at $3,228.18. That puts the gold-silver ratio at roughly 99 to 1. Now let me say that again because this is historically significant. The gold-silver ratio is hovering near 100 to 1. The 50-year average sits around 55 to 1. The historical average going back centuries is closer to 15 to 1. If silver were to simply return to that 50-year average against gold's current price, we'd be looking at silver around $58 per ounce. If we applied the historical ratio of 15 to 1, silver would be pricing above $215. The $88 figure you're seeing from various analysts represents a conservative middle ground using monetary demand metrics and industrial consumption data. But the paper market is telling you silver is worth $32. Something does not add up. Now let me walk you through what's happening on the COMEX because this is where the manipulation story gets documented with hard data. COMEX registered silver inventory currently sits at approximately 280 million ounces. That sounds like a lot until you understand context. In 2021, registered inventory was above 400 million ounces. We've seen a consistent drain of roughly 30% of available inventory over the past 3 years. Meanwhile, open interest in silver futures represents claims on over 800 million ounces. Let me be crystal clear about what that means. There are nearly 3 times as many paper claims as there is actual metal available for delivery. This is not speculation. This is documented COMEX data that anyone can verify. The fractional reserve system in precious metals makes the banking system look conservative by comparison. The Shanghai Futures Exchange is telling a completely different story, and this divergence is critical for understanding the true supply picture. Shanghai silver premium over COMEX has been fluctuating between 2 and 4% consistently for the past several weeks. On certain days, we've seen that premium spike to nearly 6%. What does this mean in practical terms? Chinese buyers are willing to pay significantly more than Western paper prices to acquire physical metal. When you factor in shipping, insurance, and transaction costs, there should be near parity between these markets through arbitrage. The persistent premium tells you that physical metal is tight enough that arbitrage cannot close the gap. This is a supply signal that paper traders ignore at their own peril. Here's where the industrial demand picture makes this even more compelling. Silver demand for solar photovoltaic applications reached 194 million ounces in 2023. Projections for 2024 are coming in above 230 million ounces. That's an increase of nearly 20% year over year in just one industrial application. Electric vehicle production globally consumed approximately 80 million ounces of silver in 2023. That number is projected to exceed 100 million ounces this year. The artificial intelligence build-out is requiring silver for everything from specialized electronics to next-generation computing infrastructure. Defense applications are accelerating as geopolitical tensions intensify across multiple regions. And here's the number that makes all of this unsustainable. Global silver mine supply is flat at approximately 820 million ounces per year. Demand is exceeding supply by roughly 200 million ounces annually. We've been in a structural deficit for 4 consecutive years now. The gap is being filled by drawdowns from above-ground stockpiles. Those stockpiles are finite. This is basic math that paper traders seem incapable of processing. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know you made it this far. The algorithm buries content like this because it doesn't fit the mainstream narrative. Every subscription helps push back against that suppression. If it's not for you, no hard feelings. I don't chase empty metrics. I don't sell signals, mentorias, courses, or paid groups. This channel exists to arm you with information, nothing more. Now let me get back to the data because what I'm about to show you is the smoking gun. Here's what makes this situation truly insane, and this is the part that mainstream financial media refuses to touch. The U.S. Mint just released their April 2024 sales figures. American Silver Eagle sales hit 2.5 million ounces for the month. That's up 35% from March. Year-to-date Eagle sales are running ahead of 2023 pace by nearly 20%. And here's the smoking gun. Despite this surge in demand, the Mint announced last week that they are implementing allocation restrictions on distributors due to blank supply constraints. Let me translate that. The United States Mint cannot source enough raw silver blanks to meet production demands, despite supposedly abundant global supply. If silver is so readily available at $32 per ounce as the paper market claims, why is the sovereign mint of the world's largest economy rationing supply? Now here's the connection that nobody in mainstream media is making. Call any major dealer right now. SD Bullion is showing 3 to 4 week delays on generic silver rounds. A PMEX has sold out of multiple Eagle products entirely. JM Bullion is quoting 2 to 3 week fulfillment on orders over 100 ounces. The Royal Canadian Mint has waiting lists for monster boxes of maple leafs. Perth Mint in Australia paused production of several silver products, citing blank shortages. This is not happening at $50 silver. This is not happening during a price spike. This is happening while paper silver trades at $32. The physical market is screaming that supply is critically tight at the exact moment the paper market is telling you silver is readily available and fairly priced. One of these markets is lying, and I think you already know which one. Let me drill deeper into the dealer premium situation because the numbers here are extraordinary. A 1-ounce American Silver Eagle has a melt value based on spot of $32.47. The current retail price from major dealers is ranging between $38 and $42 per coin. That's a premium of 17 to 29% over spot. For perspective, the historical average premium on Eagles sits around 4 to 6%. We're seeing premiums 3 to 5 times normal levels. Generic silver rounds, which typically carry premiums of $1 to $2 over spot, are now commanding $4 to $6 premiums at many dealers. 100-ounce silver bars, the bread and butter of physical stackers, are carrying premiums of 8 to 12%. These are not normal market conditions. These premiums exist because dealers cannot replenish inventory at anywhere near spot prices. Their acquisition costs are elevated, so retail prices must follow. The contrast between paper and physical has created two entirely separate markets operating under the same product name. Paper silver traders in New York and London are playing a derivatives game where actual metal rarely changes hands. Physical silver buyers in the real economy are competing for genuinely scarce supply. The paper market sets the price. The physical market reveals the truth. And right now, that truth is telling you that $32 silver is a fiction maintained by leveraged paper contracts that would collapse if more than a tiny fraction demanded delivery simultaneously. As I said in the previous video, the COMEX is a confidence game masquerading as a commodity market. Nothing has changed to alter that assessment. Let me address the bearish case head-on because balance matters, and I refuse to be a hype man who ignores legitimate risks. The paper price of silver can absolutely go lower from here. If we see another liquidity crisis similar to March 2020, silver could get smashed to $28 or even $25 in a cascade of margin calls and forced liquidation. The COMEX has raised margin requirements 3 times in the past 18 months during silver rallies. They did it in 2011 when silver approached $50. They'll do it again if necessary. This is a documented pattern of intervention to cool precious metals rallies. Interest rates remaining elevated create headwinds for non-yielding assets like silver and gold. If the Federal Reserve holds rates at current levels through the end of 2024, paper traders will continue to view precious metals as opportunity cost dead weight. The dollar index strengthening would pressure metals priced in dollars. We've seen the DXY stabilize around 104 recently, and any push toward 110 would create selling pressure on the silver paper price. Industrial demand could contract if we enter a severe global recession. Solar installations would slow. EV production would decline. Electronics consumption would fall. This would remove a significant pillar of silver demand at the margins. Mining supply could theoretically increase if silver prices rise substantially. There are mothballed projects that become economically viable above $35 silver. New primary silver mine development would accelerate. This supply response could dampen price appreciation over a multi-year horizon. These are real risks that you must factor into your decision-making. Anyone telling you silver only goes up is either lying or delusional. Volatility is guaranteed. Paper price drawdowns are guaranteed. Emotional tests are guaranteed. If you can't handle watching your investment drop 20 or 30% on paper, you have no business being in this market. Now here's the bullish case and why the fundamental thesis remains overwhelmingly intact, despite paper price suppression. Central banks globally purchased over 1,100 metric tons of gold in 2023. That's the second highest year on record. China, Russia, India, Turkey, and Poland are leading this accumulation. These nations are systematically reducing dollar reserve exposure in favor of hard assets. This creates a floor under precious metals prices that did not exist a decade ago. J.P. Morgan's vault holds the largest private stockpile of silver on the planet. Estimates range from 600 to 900 million ounces, depending on source. They didn't accumulate that position over the past decade to watch silver go to zero. They accumulated it because their research indicated silver was strategically undervalued. When J.P. Morgan is long silver to that degree, betting against the metal requires betting against the most sophisticated trading operation in commodities markets. That's a bet I'm not willing to take, and you should consider why they're positioned the way they are. The mining supply deficit continues with no resolution in sight. Primary silver mine development takes 7 to 12 years from discovery to production. There are no major new silver projects in advanced development capable of altering the supply picture before 2030 at the earliest. Meanwhile, demand is accelerating across solar, EVs, electronics, and medical applications. This supply-demand imbalance is structural and widening. Every ounce pulled from stockpiles to meet current consumption is an ounce that's gone permanently. The mathematics of depletion favor patient holders. BRICS nations are accelerating de-dollarization efforts with precious metals playing a central role in their alternative financial architecture. Russia and China are settling bilateral trade in commodities-backed arrangements. The BRICS expansion to include Saudi Arabia, Iran, UAE, and Egypt brings major energy producers into this bloc. A commodity-backed trade settlement system would require massive gold and silver reserves. This demand has barely begun to be priced into markets. The $88 silver price target assumes none of this plays out. If even half of this monetary reset materializes, $88 becomes the floor, not the ceiling. 3 key takeaways, and we're out. Number 1. The paper price of silver at $32 is disconnected from physical market reality. Premiums of 20 to 30%, dealer shortages, and mint allocation restrictions prove that acquiring actual metal costs substantially more than the spot price suggests. Any accumulation strategy must account for this reality rather than waiting for paper prices that may never accurately reflect physical availability. Number 2. The structural supply deficit of 200 million ounces annually is accelerating as industrial demand grows while mine supply stagnates. Above-ground stockpiles being drawn down to fill this gap are finite. Mathematical inevitability favors price appreciation when supply cannot meet demand regardless of paper market manipulation. Number 3. Both bullish and bearish scenarios present valid pathways from here. Paper prices can absolutely decline further before fundamental reality forces recognition. Physical holders focused on long-term wealth preservation have a different risk profile than paper traders focused on short-term price movements. Know which category you fall into and plan accordingly. The unresolved tension is this. How long can the divergence between paper and physical prices persist before something breaks? Does the paper market eventually reprice higher to reflect physical scarcity? Or does physical availability somehow materialize to validate current paper prices? One of these resolutions must occur. They cannot both be true simultaneously. The answer to this question will determine whether $88 silver arrives in months, years, or not at all. If you've been watching this channel, you already knew this disconnect was building. The question now is what you do with this information before resolution arrives. Do your own due diligence. Understand the risks. Be accountable for your own decisions. This is not financial advice. I am not a licensed financial advisor. I'm an analyst sharing documented data and reasoned interpretation. Your situation is unique. Your risk tolerance is unique. Your timeline is unique. No one on the internet, including me, knows what's right for your specific circumstances. Protect your capital. Question everything, including what I tell you. Verify the data independently. And whatever you decide, make that decision with clarity rather than emotion. Invest with logic, not hype. VIP out.